We had a mixed performance across the S&P last week, but that's not the whole story when we do zoom out year to date. Many companies, in fact, are up very strongly double digit, and today we're focusing on 6 companies that haven't had that similar strong note. The first one being Diageo. Now this one is down 24% just year to date, and if you zoom out to the last 5 years, well, it's been on a very significant downtrend. We're talking negative 30. So if you'd invested $10,000 into the stock 10 years ago, you'd now, without reinvesting dividends, be sitting on $7,000. Now, if we were to just take a quick look at their latest earnings, well, their top line growth is up 1.7%. Bear in mind, if you incorporate inflation at 4%, we are talking a real terms decrease, and that decrease also applies to their operating profit as well as their earnings per share. But management are actually putting this down to 3 different things, which they do believe they can turn around the business. First one, consumer sentiment overall. The second one, which actually more importantly and does apply to not this company but also others in the industry, is that consumers are getting less for their money. They in fact note here that households are spending 20% more for 7% less products than just 5 years ago, and that given the current economic climate, consumers of their products are in fact starting to pull back. Yet having said that, we can see their footprint is expanding quite significantly actually in the emerging markets, in particular Africa, Latin America and the Caribbean, up around 10%, whilst they do get a small drop from Asia around 3%. Now this company does have some very large strong brands that consumers continue to come back to time and time again. In particular here we have Don Julio, where in fact their sales are up 38%, double digit in all regions, so definitely one that consumers across the globe do in fact love. Guinness also up double digit, however they are noting drops in Johnny Walker around 5%, but one of the key drivers for this company, if they really want to turn their fortunes around, as they've highlighted, comes down to the non-alcoholic segment here, where they actually saw organic growth of 40%. So maybe if we're seeing the younger generation not drink as much alcohol as those in the past, this could be a really key area to bring this company essentially back from the dead. And it's quite important to understand whether or not the company is growing or in fact is it dying out. But when we look at 2018, their sales were 12 billion, where bottom line was 3 billion. Fast forward in fact now to 2025, yes, their revenue has been growing to 20 billion, but we've actually seen a decrease on their bottom line net income, a trend that has started from the last few years. So definitely something to incorporate when you're considering this company. But the other thing is this one that looks too cheap to ignore? We'll touch upon the fair value, which comes to $191. Whichever valuation model you look at, whether it's the DCF, Peter Lynch, the EVA, or in fact the EV to sales, this company does look undervalued. Doesn't necessarily mean it is a buy, because if we just take a look at the price and the average fair value, there is a large disparity between both points, telling us the market doesn't really value this company as a significant buy right now. But at the same time, it could mean right now it's time for serious consideration if you believe in the long term of this company. We also notice when we're looking at the market mood indicator, it does look oversold with the potential to bottom out, but let us know on stock number 1, DEO. We then move on to stock number 2, Adobe, which is down 29% in just the last 12 months. Not great year to date either. In fact, if you wanted to zoom out to the last 5 years, bit of a roller coaster run, really depending at which point you bought. But 5 years ago today, if you had invested, you would have also been down around 28%. It's also one that many analysts have an issue with. They do see AI coming away and eroding a lot of their moat, if you believe in fact this company has one. But what's really interesting to see, it doesn't look like the numbers are really pointing to that anytime soon, where they continue to outperform against analyst forecasts as well as raising their own expectations. And we can see just over the last few weeks they continue to increase their top line expectation. Some investors will love this, believe this is severely undervalued. On the other hand though, investors will believe this is one, as the share price has indicated, is only going to get lower and lower. Now if we go to their top line, 2017, they generated $7 billion top line revenue, bottom line 1.7. Now what's great to see, unlike Dio, we notice an increase in both top line. We're talking triple their sales and also around triple their bottom line net income. This is clearly a very large positive. And then when we take a look at the disparity between the price and the average fair value, well, we can see there are some periods of time where actually it's trading above, others where it's trading below, but right now that is what we want to understand. Average fair price based on those models, $600. Today it's trading nearly half of that, really indicating this could be a great opportunity, 72.2% below the fair value. Now, as we said, no matter which model you look at, in particular to the DCF, this one does look like, again, serious consideration if you believe in the longer term capabilities and that they can continue the strength they've shown. And at the moment we are seeing the market sentiment around the neutral moving towards the oversold level. We then move on to Costco. Now this one has been a strong performer over the last 5 years, over the last year. Year to date, very unusual for this company, but it's pretty much flat. Over the last month, we're seeing this in a downward trend around 6%. And actually, if we were to look at the last 3 months, this is one which is down double digit. Now, Costco has many ways to increase their top line revenue. One thing that they've recently done to see a boost in their sales is extend the store opening hours specifically for executive members. Not only has this led to an increase in sales from their products, but also they saw a 9% increase to those upgrading their membership to the executive level. And you're probably not surprised to note that in their most recent earnings, they beat on both top line as well as EPS, whilst also seeing members continue to climb. It's also one where both their top line and their bottom line continue to increase every single year. Now it's sitting at $255 billion worth of sales generated in the most recent annual accounts. Bottom line, it's $7.4 billion, and ideally what we want to see, not just in an ideal scenario, but for those companies we're really giving some serious consideration, growth to revenue, growth to net income. Now this is where it gets a bit more interesting. Unlike in fact the previous companies today, we're seeing the average fair value below the price, 915 versus 823, and also the vast majority of metrics here showing that actually this one is trading at a premium. In combination, we're talking around 10%. And we also notice sentiment sitting right now in neutral. We then move on to Chipotle Mexican Grill, down 26% in the last year, down 30% year to date, and over the last 6 months also down double digit. On a little bit of an incline in the last month, but we can see the picture, this one is in fact in a downward trend. And one of the largest reasons, like we touched upon earlier, the macroeconomic climate, consumers are in fact spending less, in particular to Chipotle, well, they're buying less of their burritos, and this has led them to reduce their outlook. Another strong company in terms of the growth, going from 2017, $4.5 billion on the top line, 176 million net income, now sitting at a staggering $11 billion net income. We're now talking in the billions, 1.5 billion to be exact. And if we look at the most recent year now, we're seeing the average fair value actually above the current price. Now, what does this mean? Well, actually, no matter which valuation you look at today, we are talking about upside. In fact, using them in combination, we're talking 33%. And this one is also sitting in neutral. We then move on to Lululemon, down 47% in the last 5 years, down 36% in the last year. Just this year alone, they've lost more than one half of their market cap, down 53%. And this one, pretty much every single quarter this year, has continued to warn investors about consumers. Again, macroeconomic climate, something also noted in the middle of the year, although they also specifically pointed this to the trade war that was going on, as well as, once again, pullback in consumer spending, and this has ultimately led them in the most recent quarter to in fact cut their outlook, where they pointed out that tariffs will in fact give them an additional 240 million expense, meaning less bottom line profit. Speaking of which, has in fact been climbing. We're talking 3 billion sales 2018, $250 million bottom line net income, and nice to see the continual increase, now sitting at over 10 billion, bottom line 1.8, and we're also seeing, very similar to many companies today, quite consistently, this one in fact fair value much higher than the price on offer today, where we notice you're looking at more than a 100% gain based on the fair value. Now, if we do take a look at all four models, again, we can in fact see they are pointing to the exact same thing. this one does look to be a potentially good opportunity, and once again sitting in neutral. We then move on to Salesforce, which is down 4% in fact over the last 5 years, down 16% over the last year, down around 27% year to date. These companies have truly been battered, and what's surprising, this one's performance has actually been fairly decent. We're talking a raise to their full year outlook, and not for the first time this year, and their most recent quarter was also very strong indeed. In fact, both revenue as well as profit was higher than analyst expectations, but this one also facing some issues similar to Adobe, whether or not this will be a benefactor due to AI or the complete opposite, and this one will in fact get pushed to the side. The numbers though are looking very strong. In fact, from 2018 their top line has nearly quadrupled, their bottom line even stronger, 360 million, now sitting at 6.2 billion. And whilst we do see some years in fact price and average fair value do in fact cross, as of this point right now the fair value does look to sit a little bit higher than the price today, indicating 21% upside. It is also another one that in fact is sitting in neutral. So let us know your thoughts about the 6 stocks that have suffered this year, whether in fact you see them as a buy, maybe a hold, or potentially a complete avoid. And if you enjoyed the use of Forecaster today, then do check out our affiliate link in the pinned comment below. As always, have a great day, and we'll see you all on the next one.